In this video, we are going to talk about liquidity risk within the financial institutions management world. So let's talk about financial institutions and liquidity risk exposure. You may have high, moderate, and low exposure, depending on the type of institution you are. A depository institution, just like your regular bank with checking accounts and savings accounts, are considered high exposure of liquidity. Part of it is because at any given time, the people that deposit their money may go and get it and use it from their checking accounts and their savings account. So banks, your personal banking establishments, need to have certain level of liquidity. And they have high exposure to it because at any given time, people can just on demand pull out money. Loss of confidence in bank-to-bank lending during financial crisis resulted in more widespread liquidity risk. So one of the problems that we had in the financial crisis back in 2008, it got to a point where banks wouldn't lend to other banks like they normally would under normal circumstances. If one bank is a little low in liquidity and cash, because people are withdrawing and they go through these cycles, not because they're in trouble. It's just a moment in time where they have low cash. They can borrow money from another bank while they balance out a little later. But if there's loss of confidence between banks, it can become a problem. Moderate exposure. Your insurance companies, your life insurance companies are common. They're heavily regulated. That's part of it. People sometimes cash out the life insurance or they decide to stop, let it lapse, stop paying it. But it's less common, more predictable. And a lot of times cash goes in, and if it's a term life insurance policy, they never really withdraw any money. If the term passes and they didn't die or collect the life insurance. Low exposure, things like mutual funds, hedge funds, pension funds, and property casualty insurance companies. Now, when we say that hedge funds, things like hedge funds are low exposure, low in liquidity risk, not other forms of risk that come with being a hedge fund. So it does not mean that a hedge fund is a low risk situation. They just have lower liquidity risk compared to these other institutions. Now, property and casualty insurance companies have even less exposure, as in the incidents happens a little less and people don't. Let's think about like your mortgage insurance. It just goes with it. People don't stop paying the insurance out of the blue because they can lose their house because of it. That's just one example why they have a little less liquidity issues. Now, while I'm saying sounds like default, but no, in insurance companies, you don't default. You just stop paying. Causes of liquidity risk. Liability. The liability side liquidity risk occurs when depositors or policyholders cash in claims. This is the example I was talking about, checking account, savings account. People may just go ahead and say, hey, I want my money. With low cash holdings, financial institutions may be forced to liquidate assets too rapidly. Faster sale may require what they call a fire sale price. Okay, so if you don't have cash, then you have to sell assets in order to get cash. However, if you have to sell it really fast, some things you could sell fast and not a lot of loss of value. So you can maintain some low liquidity. But other things, if you need to sell it fast, then you have to drop price a lot to get it to sell fast. And that's what I mean by fire sale price. So you have to give up take a loss in some of your assets that were not as liquid as cash in order to attain cash. Asset side liquidity risk can result from off balance sheets loan commitments. Liquidity requirements from the borrowing of funds can be met by the financial institution running down cash assets, selling liquid assets, or additional borrowing. Liability side liquidity risk for depository institutions. So reliance on demand deposits. Again, we're talking about the checking accounts, savings accounts as the main example. So they rely on those cash deposits because that's what the nature of that business is. Depository institutions need to be able to predict the probability distribution of net deposit drains. That's a lot of fancy words to say they just predicting or estimating the probability of people removing the cash from the bank accounts, large amounts, small amounts, medium amounts, average amounts. Manage drain on deposits by. So how do they manage that? So let's say people start withdrawing money. You can purchase liquidity management, meaning that you borrow money. That's just one way to look at it. You borrow money from another institution, another bank. And they say purchase because you're buying the money and the price is the interest you pay on it. Stored liquidity management, you just keep some reserves. Now, purchase liquidity management, where can they get money or buy money in that sense? Federal funds market and or repurchase agreement markets. Managing the liability side preserves the asset side of balance sheet. So you don't have to do fire sales and things like that. Borrowed funds likely at higher rates than interest paid on deposits. Yes, it's going to be expensive because you need it fast. And they know that you are hurting if you borrow money for this purpose. Deposits are insured, but borrowed funds are not necessarily protected. Regulatory concerns. During financial crisis, wholesale funds were difficult and sometimes impossible to obtain. This is related to or saying that banks were not trusting other banks. We had a liquidity problem. Stored liquidity management. Liquidity assets to meet withdrawals. In addition to reserve requirements, the reserve requirements will be the cash you keep on hand, and that's the stored one. Banks, depository institutions will keep a little extra to cover any shortages that may happen, and that way they don't have to go borrow money at high interest rates. Now, the problem is when you hold cash, you're not doing anything with that cash. You're not lending it out. You're not investing it. So we have an opportunity cost situation. And it's a trade-off. Risk versus return. You lower your risk, but then you get less return. Now, most banks or depository institutions, what they do is they have a combination of stored liquidity management and purchased. So they keep some in-house, and if they still run low after that, then just go ahead and borrow the money. But you don't want to keep too much, like we said, because of opportunity cost. Investment portfolio and asset side liquidity risk. So interest rate risk and market risk of the investment portfolio can cause values to fluctuate significantly. As the market conditions change, the market value of your assets are going to change. And this can then translate to increased liquidity risk if the value is going down of your assets. There are arguments that technological improvements have led to improvements in the liquidity of financial markets, meaning a lot of different meanings, but one of them, for example, it's that more participants in the financial markets because now it's easier, lower cost. Technology has done all that. So more people can access it, so that improves liquidity. However, some argue, as you can see down there, that the herd behavior may actually reduce liquidity, meaning that herd behavior, just what it sounds like, follow the leader, and if they all do the same thing and decide to stop buying, stop selling for whatever reason, or pull out of the market altogether, then that can actually lower liquidity. Financing gap. Defined as difference between average loans and average core deposits. These are the ways to calculate it. So it depends on the information you have, the data available. But you can get the average loans minus the average deposits as defined. Another way to look at it is, well, minus the liquid assets plus borrowed funds. You can say borrowed funds minus liquid assets. They're just following the balance sheet order. And that's why you see here, it's just this same formula turned around. They move liquid assets next to financing gap plus liquid assets equals borrowed funds. Managers of depositor institutions need to actively manage liquidity planning to prevent potential insolvency. So as the market conditions changes, as loans come in or go out or are defaulted, it's constantly changing, a moving target, and they got to keep on going up and down on these in order to maintain a nice financing gap. Financing requirement is the financing gap plus the depository institution's liquid assets. They're just talking about this one right here. So financing gap, the difference between these two, the financing requirement is this plus this. In other words, how much you'll have to borrow in order to stay liquid. Peer group ratio comparisons. Just what it sounds like. If you want to get a sense of where you are, you can just compare yourself to your peers. If you're doing about the same average, below or above, then you can adjust accordingly. So compare key ratios and balance sheet features, loan deposits, loan assets, unused commitments to asset ratios. A high ratio of loans to deposits may indicate a heavy reliance on the short-term money market, resulting in future liquidity problems. And that's just one out of many potential alerts you may get when you evaluating your ratios and compared to your peer group. The liquidity index, measure of potential losses a financial institution could suffer as the result of a fire sale disposal of assets. Now remember, fire sale, you're going to have to drop the price in order to liquidate those items fast and get some cash. And that's what they call the disposal of assets. So that's the formula to calculate it, is a weighted for the formula. And what you do is you take the weight, the weighted sum of the fire sale price. That's the low price that you're going to sell it for, to the fair market price, what the normal price would have been. So you notice you're taking the cheap price that you're selling it and for the fire sale to get the cash really fast, divided by what you could have sold it if you were not in some kind of situation where you had to do the fire sale. Where the portfolio weights are the percent of portfolio value performed by the individual assets. The portfolio is going to have a bunch of different assets in there, and that's how you do the weight. Let's say you're going to sell some inventory or some other marketable securities that you have, you just weight it accordingly. Ratios. We can talk about liquidity coverage ratios. These are similar to the ones you've seen in previous courses. They just applicable to financial institutions. For example, the liquidity coverage ratio in this case, you take the stock of high quality liquid assets, how much you have of that, and you divide it by the total net cash outflows over the next 30 calendar days. In other words, you're covering your cash outflows for the next 30 days with your high quality liquid assets, or you should be able to cover that if needed. Net stable funding ratio, available amount of stable funding, required amount of stable funding, divided by the required amount of stable funding, and you want that to be above 100% or above 1. If not, you'll be in trouble. In other words, available divided by required. You want to have more available than what it is required. That's the message, and that's what has to be above 100%. We're going to go ahead and stop the video here. This will be the end of part 1 of liquidity risk. We will continue to part 2.